Wall Street faces a monumental week, testing the resilience of its unstoppable rise. Traders are staring down a pivotal week that will likely set the tone for the rest of the year in markets and the economy. The Fed's interest rate decision, a string of big tech earnings, and some key indicators on the state of the economy. Add President Trump's tariff deadline, and it could be the last big trading week of the summer. So, what should we expect? Chris Rossbach is Chief Investment Officer at J. Stern. So, Chris, let's start with the Fed. No cut is expected, but will we see the central bank laying the groundwork for a move?
I think that the Fed has said very clearly they're going to be data-driven in terms of their decisions. And in the fairy tale, Goldilocks is just right. But in real life, the economic data is always going to be too hot or too cold. I think there's also a lot of pressure on the Fed for a rate cut. And with what we're seeing, which is that the underlying economy is strong in many ways, and the effect of the tariffs have been in part inflationary, but in part offsetting because they've led to a slowdown, then that does point towards a moderation in US growth. It does point to a moderate impact on inflation. And if that happens, then yes, there is room for a rate cut. And I think we're going to hear data and information from the Fed that is going to be pointing in that direction.
So when could we see those cuts starting? Could it be September or December from you?
I think there's no particular rush at this point because of the underlying strength, but at the same time also because of the uncertainty around trade and where these agreements are going to end up. So I think expectations are it could be as early as September, but I certainly think by the end of this year, it's quite likely that we're going to have a cut.
Meanwhile, Friday's job report might be the most important indicator for how soon the Fed will cut rates. Do you expect a continued slowdown in hiring?
We've seen a resilient jobs market so far, along with resilient consumer spending and other types of indicators. But a slowdown is natural. We've also seen that companies have paused some of their investment and their spending, and we've also seen that consumers have paused some of their consumption because of the uncertainty. And so after the strong performance that we've had, I don't think it would be surprising.
Switching now to earnings, Chris, and tech giants are reporting this week. Overall, investors have been unimpressed by a strong start to the earnings season. Will it be the same for these mega cap stocks?
So there's reasons why in some cases the reactions have been subdued to the actual numbers, but it's got to be seen in the context of a 20 to 40% rally in many of these stocks from the lows that we've seen. So I think we're looking for confirmation in these earnings. This week is going to be big in terms of some of the big companies that are reporting. But I think if we get confirmation that these underlying drivers are intact, that search continues, that activity continues, that AI activity continues, and that CapEx continues, which I think all we're going to get confirmed because of the strong underlying fundamentals, that'll provide a very sensible backdrop for the second half of this year.
So finally, Chris, Trump's tariff deadline caps off the week. Are markets now looking past trade threats, or should we expect some clarity?
Well, I think we are getting clarity, thankfully, because it turns out in the US that what must happen will, and what can't happen won't. And so the guardrails by the market, which we saw in terms of the bond and also the equity market, have held, and also the guardrails in terms of the real economy. I think the best example for that is the eventual decisions that we've now seen around semiconductors, where we've seen NVIDIA being authorized to sell the H20 to China because the global semiconductor industry and trade is so critical for the big players, US, China, Europe, and others. And so the fact that we're getting to an outcome where we have tariffs, which is regrettable, because we would be better off without them. But we are in a situation where it looks like 10%, 15% tariffs for Europe, and we're going to see what comes out of the negotiations with China. We've seen with the most recent news that the US has taken steps to effectively have a constructive discussion with China, even around some of the symbolic actions they've just taken. It's very likely that we're going to have a pragmatic outcome, and I think that will be very positive. I'm sure it will never be entirely off the table because this uncertainty is negotiation leverage for President Trump. But if we have a greater sense that the guardrails will hold, that the fundamentals of the economy are what is going to ultimately drive the policy, that's very good news. And again, I think it sets us up for a very good second half of this year.
That was Chris Rossbach of J. Stern. Don't forget, you can watch more videos on Reuters.com.